All right, so we continue the up and down choppiness of the past so many weeks with today's move to the upside. So I guess you could say the best thing again that happened was the fact that the worst case scenario didn't play out. So the low point set again, the third attempt to the low so far, has set. Now the question is, how far up are we going to go on this current run? Are we going to get back to the top of the range, where there's going to be a pretty good, strong defense of bears at the top, ready to put some battle forth and keep us there? So, are we starting to see some signs that the new bullish intermediate run will be starting soon? I'm going to show some of those signs today. And I'm also going to talk about kind of what's driving the bullishness that we've seen. It's been hidden in the shadows because everyone's talking about yield curve and recessions. That there's a big move in a certain asset class that typically has linked to the risk trade and how that might impact things. And then our trade idea of the day takes advantage of that. So let's go ahead and get started. Today is Wednesday, August 28th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and start off taking a look at the S&P 500 with the Market Forecast Indicator. As you can see, we continue to have the bearish pattern of dark pink shading, red line, falling market sentiment, though market sentiment's weak, and we haven't fallen below these lows, out below this retracement zone yet. So kind of need to do that if we're going to be bearish, right? We can't call a retracement a bearish trend until it's not a retracement, and it's not a retracement when it passes through the retracement zone all the way to the other end of the retracement zone. Even then, it can be a deep retracement until you break through the 100% level. Then you've got your bearish trend developing. So, but you still, bearish pattern signify, kind of it's an intermediate pullback. The intermediate line's below 50. The market sentiment is not below 50, so we don't have a market sentiment pullback. But we do have an intermediate pullback, and you tend to get, when you get those dark pink shadings, red lines. On the weekly chart, this week you'll see that, we did have the yellow line and light pink shading last week going into Friday. This week, considering the bounce so far that we've had, we might be right back to a green line. It'll still be light pink shading because it's still pointed lower. But again, as I mentioned on Friday's video, that's a bullish pattern for the S&P 500 on its market forecast chart. Let's go back to the daily chart. You can see that all the patterns remain the same. We had a nice little bounce today. It brought here's the one positive development. During this intermediate pullback, every near-term low point has reached the oversold level except for this one. And you can even see the momentum line really dove sharply on this last this last drop, but this one didn't. And so here's like the first time that, even though we did hit the same levels, the near-term line didn't drop, the momentum line didn't drop to extreme lows. And we've now bounced. So, this could be this low point on the near-term level is compared to the last near-term low, right about equal or higher, even though equal or slightly higher, even though the lines itself is much higher. The lows on the near-term line itself, are much higher. So now it's not above 80 yet, and that's why we haven't been going anywhere, because we followed up every bearish near-term low point with a bullish near-term high point. Well, now we followed up. This is the first bullish near-term low that we've gotten. That's a good sign for the markets. Out of the three, this is the first bullish one. Now the question is, if we follow up, if we go bullish near-term high to bullish near-term low to bullish near-term high, that is a bullish trend, and there's a good chance that will bring that intermediate line finally up above 50. The intermediate trend does not get started until that intermediate line crosses above 50 again. That's when you get the dark pink shading. And that's when the intermediate line, the intermediate trend starts, the countdown starts, right? The 1 to 3 month typical intermediate run. Of course, for that to happen, more than likely, you're going to have to break up above this top of this range, this sideways range we've been in. And your near-term line is going to get above 80. It has to get above 80. The momentum line doesn't have to get above to its own extreme highs, which would be above 90 in this case. It would be nice if it did, but it doesn't have to. You can see we did over here. We got above 90, the near-term line. So we thought, okay, there's there's a good chance we bounce off this, and we had brief dark pink shading, but we can bounce off of this and head higher again. But that didn't last very long, right? As you see, light green shading and yellow line can be a selling opportunity, and that's what it ended up being as we pulled. We've been pulling back down ever since. So now, again, we need to get through, because at some point in time we will also get light green shading and yellow line here. We have to get to that level first, and then work our way through that before the trend turns positive. You look at the Dow Jones, very similar patterns. The NASDAQ, the difference here is the near-term line didn't quite get above 50 like it did on the Dow and the S&P, even though you are coming up off of a bullish low point. And the Russell 2000, which has got the worst intermediate line, all the rest of them are at 28th percentile. The Russell's at the 13th. It got the cluster yesterday, the second cluster it's had during this intermediate pullback. Its market sentiment line is also below 50, so that's different than what we saw on the Dow and the all the other large cap indexes. In fact, this is the second time it's pulled back. It's like this was on the intermediate pullback on the Dow and the S&P, but it was a market sentiment pullback for the Russell because we didn't go up very high. Same thing here, we didn't go up very high on this peak like we did on the large cap indexes, and we're already back down below 50. So in fact, if you look at the weekly chart here on the market forecast, that's a pretty ominous picture here. Dark pink shading and red line. I mean, if it wasn't for this chart here, I would be loading up for a bounce off of this Fibonacci retracement. But just in case the floor falls through because of this, really, because of the pattern we're seeing on small cap stocks, we have to be prepared for that floor to fall through on all these indexes and for the markets to get more bearish than they already are. Remember, the S&P 500 is showing a bullish pattern of light pink shading and a yellow line. Well, so did the Russell 2000. And then, now this week is the first week that's changed. Now, the week's not over yet, but most likely this is going to be the week where that's changed. And we've seen in the past, here we had a few weeks of that kind of bearishness back in October 14 before we rallied. So it doesn't necessarily mean that we have to pull back like we did here and like we did here. But there's a good chance that can happen. That led to a death cross, that led to a death cross on the broad market as a whole. So we need to be prepared for something like that happening based on this picture. Though the likelihood though is still relatively low when you look at all the technical pictures, including some of these other charts that we'll look at here in just a minute. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells me two things. Number one, you like the video, you got something out of it. Number two, you want us to do it again tomorrow. So if you like these videos, if you want to see us do it again, give us one click. That's our feedback that we get from you. You can do that right now while you're watching. Comment down there too on anything that stood out to you from today's video. Join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click up on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day. Make sure you're liking and retweeting that content so that Twitter keeps pushing you that material. Again, not everybody who follows my Twitter account sees my tweets. So even if you're not there when I tweet it out, they'll still show it to you the more you like and retweet them. And then finally, join our Market Outlook community that we've created on Facebook. All right, before we look at some other charts here, just a reminder that we do have our new Market Outlook live video going on at 3:30 Eastern every day. The link to that is not every day, on the days that every day that I do the Market Outlook. So we're still not to the point where we're doing it every day yet. I'm still working out the kinks of the technology. But that does go on at 3:30 Eastern time. The link to that is right here, Market Outlook Live. And of course, this is available for all of our Plus and our Premium subscribers. So if you want to try us out and get access to that, you can subscribe to our monthly subscription, our monthly Plus subscription, and get a trial for that initially. and then that will give you access to all of this. And that subscription gets you access to my technical analysis class on Fridays and Brandon's DGI class, one of our very popular classes we have here on Tuesdays. We also, so you can see the rest of our schedule over here on the right. We also ask that you engage with us on social media. You can see there's the Market Outlook tweet and Facebook post for tonight's video. We got up to 100 right before the video started, right before I started prepping for the video here. So that was pretty nice to see again. And again, the more you engage with us, the more Twitter and Facebook will promote our content to the top of your timeline. And not everybody who follows us sees our content, because that's just how their algorithms work. So to make sure you see it, we try to make it really easy for you to engage. Just click this heart. You can hit like there. You can also retweet it to, you can also, if you click on it, you can retweet it to, and then of course, when you click on this image, it takes you to your Facebook page. Like and share from there as well. Commenting on the tweets is also another way that shows these social platforms that you want to see our content. All right, back to the charts. Let's take a look at the long-term chart, the 1040 crossover. And you can see how the ranges have been, on the Heikin Ashi at least, have been getting progressively smaller. Remember, the highs, when the open is a high, doesn't necessarily mean that that's the week's high. But anytime you see shadows, right, that's the range. And you can see how, it's a really, really small range this week. If you look at the regular candles, very, very small, kind of a harami type pattern fitting inside of completely inside of last week's range, and still above the 200-day moving average. The momentum is down. You can see here it's still positive. This is not as high as it used to be. If you take a look, if I go back a little bit further and you take a look at where we're at here, this is kind of the level. I mean, there's a few times over here we got closer to zero, but you can see there's other times here in 2012 and in 13, and again here in November, or excuse me, October, November of 16. You can see these are about the areas that we pull back to, and even over here in 99 and 2000 before we rally back up again. So if we don't, then the next kind of layer of support for the S&P in recent history has been zero. And there's only been a few touches in that area before breaking through with these death crosses. These are obviously when you get the death crosses here. Brief death crosses for some of these areas. Let's take a look at the 3 green arrow chart. And of course we have 2 red arrows. We have a green arrow on the MACD. Let me show you what that looks like on the 2-line versions. The MACD is still above its moving average. That's why you're still above, the histogram is still above 0. The stochastics dropped below its moving average, so we'll see if that follows through with the MACD. You can see today's move got us back up to the 8-day moving average. Remember, it's that 7, it's one thing to close above the 8-day moving average, which we haven't done. I mean, I guess you could say technically we closed above it by 1.5 points today. As much of a breakout that was. But the reality is, the closing above the 17-day like this is kind of that next stage. And then, of course, you need the MACD to get above the MACD here to get above 0 kind of at the same time, which never occurred here. Kind of made that a little bit of a false breakout. And then that last stage of reversal is getting both these lines across up above the 30. So we're just barely kind of sniffing that first reversal stage of the 8-day crossing above the S&P crossing above the 8-day moving average. Of course, when you look at like the Russell, which has been a lot more bearish, it never did cross above the 17-day here like the S&P did. So kind of another false signal there, and it's still easily below this falling 8-day. Though you notice here the MACD is forming, after this positive histogram. These next 2 negative histograms are forming higher lows, even though we're slightly lower lows. So a little bit of a bullish divergence, MACD divergence, with the stochastics as well, for that matter, if we end up bottoming out here on the Russell 2000. Another small sign that we might be trying to figure out a low point in this area here. All right, if you take a look at the if you take a look at the S&P on an intraday basis, you can see how we're kind of at this point at the high today where this little volume node ends, where the void starts. And so don't be surprised tomorrow morning if we don't rise up really quickly through this area. It might seem more bullish than we actually are. And if there's a gap, and we don't break above 292.5, which I doubt, but if there's a gap up tomorrow and we start to fill that void really quickly, we're going to fill it. We're going to pull back, if not by the end of the day, relatively quick. So, we'll see if we don't get a gap down tomorrow into this 287.5 maybe before rallying through and then filling that void, which would be really bullish. That could occur tomorrow. It might be Friday. But there's not very much resistance. There's less resistance above us than support below, than below us in terms of volume. So it'll be easier to go up than down. But remember, in the after hours, when there's little volume, regardless, it can do anything. So the ideal scenario, if it's going to go higher, is to start lower, fill in the gap, and make you through there. If it starts up in this area, then just like we've seen before, you can come down here really quickly, right? Just like we did over here on Monday and Tuesday. Because there's a really strong resistance here at 292.5 on an intraday basis. I'm going to venture to guess that we're probably going to need to gap through that area with some good volume on some kind of overnight catalyst for us to say, okay, now we're taking off on this new intermediate rally. Until then, noise, right? Until either we gap through the top or we gap through the bottom, noise. There's going to be noise, in the markets. Let's take a look at the volume in the trading range today, which were lighter. So the volume has dropped all the way back. So we had, this big kind of spike in volume. We've had two spikes in volume on the down days where we've hit the lows. And there was the first one. Then the next time we hit that same low. And then the third time we hit that same low. And unlike even the second time, see, the first time we hit that low point, we kind of gradually built up to it. And then we still had some pretty strong volume kind of establishing the low point down here at the bottom. And then the second time we hit the low point, and then we gradually fell to some really light volume, typical summer, August volume. And then we had this one-day selling here that got us to the third time to that low point, and then we immediately fell down in the volume. So you can kind of see here how each successive drop to the low point has been kind of less bearish, with only, in this case, only 1 day of bearish volume, and the rest of it's back here to more bullish volume. But see, even on the Fibonacci fans, we're still not up above into that Fibonacci area yet, and that's kind of what you need to see if we're going to break up and make a run back towards 300 and beyond. But the trading range below average, 3.8 points, including overnight trading, so 3.82 points, 59 million shares in volume. That's 3.89 is right here, so it's below the average. 59 million shares is also way down here, actually. That's pretty darn low. So again, when you see these lines move down, and you see that the ATR on a relative basis is kind of holding this 1.5% area, which is kind of where it peaks and where it can peak in intermediate pullbacks. It's when you get to the 2% is when you worry. That's the surge, right, where you worry about more of a market sentiment pullback. The other thing too that kind of tells you about the market sentiment pullback is the surge in volatility, which still we haven't gotten yet. We never did get up above 115%. We surged it to extreme highs. Which again is typical of intermediate pullbacks, but not the 115% surge high points. So, and we're back below 1%. We're dropping down. We dropped all the way down by the end of the day today. And again, I wouldn't be surprised if we didn't. Ideally, you'd like to gap up on volatility and then work your way down through 95. If instead we gap up into that void on the S&P and we gap down on volatility like this here, don't be surprised if we don't rally back up. By the time by all is said and done, and continue the noise into the end of the week. So we'll take a quick time out and kind of summarize the technical outlook. We've got small signs that this intermediate pullback might be bouncing, but still a really, really small technical signs yet. We're still in the midst of this intermediate pullback. We're stuck in a range that we're going to probably have to gap our way out of, either to the upside or the downside. And right now we're trading closer to the lows, which means that we'll have bounces to the upside like we did today. But nothing suggests that this is the bounce that will break us through. It could be, but nothing yet other than some small signs on the market forecast and other indicators. So, I mean, we can look at some small bullish positions. There you can start to build. I wouldn't build into any significant bullish, especially trend trading positions, until we get more signs that the intermediate rally is closer to starting or not. So what do you think? Do you agree, or before that, the best thing though is support still holds, which we expect it to do until it doesn't. Support still holds. There's a good battle line drawn both to the upside and to the downside, and so, you know, considering that the market's priced in for the worst case scenario, right now we've still avoided the worst case scenario, and still look to avoid it going forward from here, even though we only still have small signs that we're starting to move higher. We might not be starting it yet, but the worst case scenario hasn't unfolded yet either. So what do you think? Do you agree or disagree with that? Click that link right there on the top right corner of your screen. It opens up a poll. Then hit either agree or disagree. If you hit disagree, comment down below in the YouTube section on what you're seeing from a technical perspective that would suggest otherwise from what we just came up with here. Again, share whatever charts or indicators or studies that that show you a different pattern than what we're seeing. All right, so now let's break down what's driving the price action today, and what really didn't get a whole lot of pub in terms of why we rallied. And we're at kind of the highs of the week, and that's a pretty decent gain for the week. But you can see that long-term bonds are up too for the week. So it's not like this is all like risk on, right? You can see also that gold in red, it's also up for the week too. But the main reason why equity prices, more the U.S. equities than international, but the reason why they rallied so much is because of the rise in crude oil. It's a tremendous rise in crude oil today, going up, with the close yesterday, really right around midday yesterday, finishing up 2% for the week after starting the week strong. And then now, at one point in time, up almost 5% for the week on this early morning gap up higher today. So that's one of the biggest reasons, despite the pullback, we're still up almost 4% for crude oil. Let's take a look at its intraday chart here, and you can see what that rally looks like. It's right in this area here. These last couple of days of rally, you can see what that's done for the price of crude. And if you look at USO with the gaps, you can see that that's what it looks like with the gap. So it pulled back just a little bit there. But if you take a look at crude oil itself, again, you have you're almost about to have dark green shading. You're up 49 percentile, so almost 50 if you round up. If you look at the moving average here, it's gone from 55.43 to 55.43. So it's depending upon what the thousands place looks like, you are just maybe another day away from them, depending upon where we close today, another day away from the moving average turning up, which would make it green since we're trading above it, and dark green shading in the background because the intermediate line rising above 50. Again, bullish combination. And considering how crude oil has kind of led the risk trade here up and down lately, for us to get going, we need crude oil to get going. So that's a positive development for that. Like I said, this didn't get a whole lot of pub today because the biggest news of the day was the 30-year note dropping below 2%. Now keep that in mind. Inflation typically runs around 2%. At least that's the target for long term. So essentially, if you hand your money over to the government for 30 years, you're essentially not going to get any return at all, with the coupon not able to cover the annual inflation levels over that 30-year period. And basically, just doing enough to cover the inflation that will work its way, that will bring your investment down by the end of the 30-year period. So big time drop, breaking significant levels to the point where the S&P 500 now is yielding more. And the last time the S&P 500 yielded more than the 30-year bond was not at the beginning of a recession, which is everybody is in the whole market's pricing in, right, with bonds and gold and everything. The last time a 30-year note, the yield, fell below the S&P 500's yield was not at the beginning of a recession. it occurred at the very, very end of a recession. And that actually signaled the bottom. March 2009, the bottom was set by the fact of the 30-year note yield falling below the S&P 500 yield. So that's a very, very significant occurrence. Doesn't necessarily mean that we're going to bounce up from here, because anything can happen. All right, and the main reason for this decline since last November is not the midterm elections, as some people on Twitter have been putting out there, but it's because of the yield spread between the U.S. and Germany and the equivalent bonds. Especially their negative rates over there, drawing our yields down. So that yield spread, which is actually still really, really high levels, which means one of two things: either we're going to keep dropping, which is unlikely considering, again, how extremely low they already are. I mean, of course, they can keep dropping, but we just, in the short term. But in the long term, I'd expect a year from now the yields to be higher than 2% than they are below. So that's on one hand. But on the other hand, the German yield would come up to close that gap. And so if German yields are going to be coming up, then U.S. yields will be coming up too. You would just hope that German yields come up faster to close the gap that way. So those are the two different ways that you can close that gap. And considering the gap was created this way, it'll be interesting to see how, and again, the last time we were the spread between U.S. and German Treasury yields was as high as it was back here in the late 90s, right into this area. And you can see it fell initially, but then really kind of rallied before the recession brought the yields down and made bonds so attractive. So initially, you can see the yields drop just like it did now. And remember, the Fed cut rates in 98. In the fall of 98, during this time where yields were falling so hard, they also did it here in 95 and 96. So when you had yields falling as hard as they were, creating this big gap with Germany, the Fed cut rates to bring these rates down in line with what we saw in Germany. Yields took off from there. And so all those yields, before the recession started, and again, the tech bubble burst, so yields took off. In fact, I saw some people say that right now what we may be seeing is, the biggest bubble we may be seeing is actually the 10-year note. The bonds, long-term bonds, being as bullish as they are, that might be the bubble that bursts. So we had the tech bubble, the real estate bubble. Now it might be the debt bubble. It's not just corporate debt either, but treasury debt bubble, as bullish as been, not just here, obviously in the U.S., but also in Europe too. So there's very little news today on the economic calendar. Tomorrow's the GDP revisions. After they advanced, we'll get the first revision, and then we'll get some trade data. And so we'll kind of keep our eyes on those things. A lot of people will be looking at that. And then finally we finish the week with the Chicago PMI. But that's going to be a big element. Right now the GDP estimates remain pretty high, and they won't be updated until the 30th. But these estimates remain pretty high here. Still at 2.3%. So again, hardly a recessionary estimate going forward. Of course, things can change by the time the actual result comes out, of course. But if you look at the economic surprise index, another sign that yields will find their low point and move higher is because this has rallied so much. And typically this is bullish for yields when the economic indicators on the whole are outpacing their estimates. Now they're not outpacing them yet. We're not above zero. But they're coming in below estimates at a smaller level than they were previously on a rolling 90-day rolling window. Same thing globally. You don't see the chart updated here, but 13% would be up into this area. So they're not above zero, but they're much improved, which means that we're getting better economic indicators as a whole than what we've seen. Of course, you can see the Chicago PMI. All these indicators kind of peaked. We don't see the chart here. Let me see if personal income, if this shows the chart. I don't think it shows the charts quite yet. No. Let's see if durable goods has a chart on it over here from Monday. A lot of these indicators peaked on August, and then they kind of have been bottoming. It looks like they've been bottoming out here. So the question, as we'll see, and we don't see the chart there either, but the question is, are these bottoming out and rolling back up again? And we'll start to see that with spending and income and PMI coming up, and of course trade data coming up here tomorrow. But as you can see from the economic surprise index, that might actually be the case. That the descent. Usually, economic indicators will surprise in the direction that they're headed. So we've been, since August of 18, when we crossed below the zero level here. That's when things took a turn on the year-over-year charts for a lot of these economic indicators. Well, now those year-over-year pullback might be bottoming out here as we head back up towards zero. If we get back above zero, they'll start turning higher, which will mean that yields will find their low point and move higher too. So that appears to be the pattern that is setting up here. As we've rallied this week, it's been a pretty broad rally. All the sectors have been participating to one degree or another. Utilities and real estate lagging behind, as you would expect, if they've been the biggest winners over the long term here. You've got a lot of cyclical areas in here. Consumer stocks have really been leading. The consumer has been the story as to why the U.S. Economy has been still holding up, and why the stock market hasn't fallen 20+% like we've seen in a lot of other places. And you can see those stocks, both on the staples and discretionary side, both leading the way higher today. And then your communication stocks, your Facebooks, your Netflixes, those types of stocks. If you take a look at the different kinds of stocks and how they performed, there's your S&P 500. You can see your value stocks did really well, and as well as your dividend and your low volatility with high dividends. Low volatility by itself didn't do so very well at all. So those dividends stocks have really kind of done well today. You can also see too buyback stocks that are issuing buybacks outperforming. On the low end, you have momentum stocks lagging behind. That's why you don't have technology or those kind of more cyclical. And right now, utilities and real estate have been the biggest momentum. Not surprised to see those areas lag behind, and then your growth stocks coming in behind as well. I did want to mention this idea between this high beta and the low volatility. I tweeted out today, and again, make sure that you're following me on Twitter to see and that you're engaging with these tweets that you see in your timeline to get all of them. But another sign of how bullish we are, how overbought the safety trade is you take a look. This is the ratio of low volatility to the high beta stocks. That ratio is as high as it was in early 2016, higher than it was in 2012 when QE2 ended. And we were trying to figure out right before QE3 started, excuse me. So I mean, that's a pretty, we're pretty darn bullish on this ratio, really overextended to the upside in terms of the safety trade. Again, the recession hasn't started. We haven't even started the death cross yet, like we saw here. And yet the safety trade is already as bullish as it is. And there's another sign. And we saw today that low volatility kind of worked its way to the downside. And what you have leading the way higher are two of the three main growth cyclical areas. Communication services now with those tech stocks in them, discretionary stocks, and then technology, which started the week relatively strong, kind of pulled back here today, and not as strong of a day today. In fact, if I take a look, you can see over here, if I pull up the sectors, technology was one of the laggards behind. Energy, so oversold, was one of the bigger winners. If I go back to the regular 3-month chart, I mean, that's where any value there's going to be is that energy sector. Of course, you got to break up to above old highs to start to realize some of that value. But it's really, really oversold, even just on a 3-month basis. Of course, if I were to go out to a full year, it's down 25% while the market's flat. And then you can see the safe haven trades, how bullish they are over this 1-year period, 250-day period. All right, so for our trade idea of the day, now remember we put this trade on already in the Market Outlook live session earlier at 3:30 Eastern time. We also discussed in that video past trades. In fact, we closed a few trades today. So that's what we talk about in that live video, is the management of existing trade ideas And some of them we hit kind of targets. So we closed out with some gains today. And then we also put on today's trade before the market closes. And the stock we looked at in one of those cyclical areas that, like the market, is showing small signs of a bounce, and that is UTX. You can see after forming a couple Harami patterns here after this would be what, last Friday's low point, we got a little bit of a bullish engulfing pattern today, bringing in the near-term line also into the upper half of its chart off of a bullish near-term low point. Even though we have a slightly lower closing low here. Yeah, the market sentiment, the market forecast is still showing that bearish posture, but again, like the S&P, you've got some positive developments here. If you look at the 3 green arrow chart for UTX, you can see how we got back above the 8-day moving average. The MACD is above its moving average. Stochastics is kind of flirting with its moving average and trying to get it going. Its moving average itself is still rising. The MACD's moving average is rolling up to the upside. So positive developments here. When you look at the Bollinger Bands, you can see we're sitting right at the upper band. So we have an opportunity to kind of break out here, or we bounce down and continue lower if the markets bounce down. So considering that we've kind of held when we were kind of in the middle of this void, we got down to the middle of this void here. Instead of filling it all the way down to 190, we stopped and turned around with this bullish pattern. That's a positive sign too for a stock like this. And you can see when I look at its long-term chart, especially when I look at the regular chart, regular candles, we had this big hammer pattern a few weeks ago. We filled in the range but closed above the high. We closed below the low of that candle last week on 2 kind of consecutive weeks below the 200-day moving average, and now we're back up above that hammer low point this week. And again, you know, like as we've seen before, when you close below the 200, we can bounce right back up above it, and we'll see if that ends up being the case again for UTX. Considering again this idea that the broad market itself, you know, you prepare yourself with hedges in case the floor falls through, but we're also at the floor, which means we have the opportunity for decent small trades to the upside if the market does bounce and we do start the intermediate run. You would expect a decent run out of a stock like UTX. So we took a look here at selling the 135 call option and buying the 130 call option. That gives us a if I analyze this trade and go to the risk profile, you can see we got in, let's see, with about, what, $1.18 or so, or no, excuse me, sorry. How about I just trying to do the math in my head and just do it here. $1.78, $1.80 is what I meant to say. Right now it's at $1.55 to be able to, excuse me, $1.75. I don't know what I was thinking there. $1.75. Let's get rid of that call. There's the $1.75. So it's about the same levels where we got into. And again, if we get to right now, the current range says we can get all the way up to 139. Well, if you look at the charts here on the Bollinger Bands, breaking up through this and getting up to 139, you can kind of see if you get above this volume node, you've got a pretty decent opportunity to run at least up to 135, and that's where we sold. The call option here was at 135. Again, we can limit the risk to $175, half of that, right? We go for a half of that on the trade, and then go for the potential reward up to the upside. So if I were to take off what we put on here, you can see, you know, if I limit my losses to about $80. You can see how how hard it would be to get maximum loss, but you can see a decent move to the downside would get you to your 50% loss. So if you can limit your losses to that 50% and then go for, you know, so $80, but then go for a $325 dollar reward to the upside, if we get up to 325 and stay there, that's a pretty decent 4-to-1 reward to risk ratio. And then the worst case scenario, 2-to-1. Reward to risk ratio. That's if you forget about this trade altogether and let it go all the way to maximum loss. Which again, for long verticals, it's kind of hard to get to maximum loss unless you kind of just let it break out on you and forget about it and just kind of let that lottery ticket play out. And even like I said, worst case scenario, you still get a good reward even in that type of environment. All right, so that wraps us up for today. Again, you've heard from me now. Now I want to hear from you. Use that link right there. Let's go to our Market Outlook forums on marketscholars.com. You have to be logged in to participate there, but make sure you subscribe and log in. But any questions or comments you have about today's video, make sure you open up any new thread, and let's keep this discussion going with other market scholars that watch these videos like yourself. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content in between the videos, and then join our community at Market Scholars, as well as the community that we've created for Market Outlook viewers on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.